Hello folks, this is ICT with the Scout Sniper Basic Field Guide, Part 7 in our continuing series. After this, we only got one more installment left and we're complete. Okay, we're going to be looking at multiple targets. Okay, and what specifically will we be covering in this presentation? Well, we're going to be reviewing the previous assignment, discovering the average number of pips intraday, a study on that. And we're looking at the ICT chart examples and stop loss orders revisited. And we're going to be looking at the average daily pip ranges. We're going to be discussing when ranges contract and why it's essential for you to be prepared. And the 30 pip stop loss and why. We're going to be looking at the ICT split gains ratio. Okay, and why is it important to understand your trade setups? What is the concern? What makes a trade different to any other? Why is classification essential to profit taking? And the ICT split ratio is explained. We're going to be discussing, are we in sync or not? Intermediate term ratios, short term ratios, day trading ratios, and finally scalping ratios. And in conclusion, we're going to have one more assignment. This is the last one in this series. It will be basically a review for you to go through all of the previous videos one more time, try to gather up all your notes again, and we'll be moving on to the final conclusion installment to this series. I think what I have planned and outlined is still a little bit more to work to be complete, but what I have so far, you'll be very very surprised to see how these tools are used and when to use them and when not to use them. So let's move on. Okay, folks, we're looking at the Euro USD. It's a 15-minute chart, and keeping in line with this teaching series, obviously we talked about how trading in line with the higher time frame daily and using the 9 and 18 moving averages, exponential moving averages rather, to kind of give you a buy model for institutional flows. So I more or less used this section of the marketplace, basically the 30th of September through the 4th of October. So if you can pull that up on your chart, you'll be able to do the same markup that I'm doing here. And I have each day delineated with vertical lines, and you can do that in MT4 by holding down Control and tapping Y. You can see that happening here. And these horizontal lines, let's take the vertical lines so if you can see it a little bit better. This is delineating the previous day. Okay, this is previous day's high, which is seen here, and this is the previous day's low, which is seen here. Okay, and I'm going to share these tools on the internet, and you'll be able to download and apply them to your MT4 platform as well. We're going to look at a few things here, obviously, beginning with the average pip range. So this day's high to low, using this here, we have 78 pips. See the middle number here? 78 pips. Okay, so on this particular week, this Monday, it was 78 pips for that particular day. This trading day, we had the high here and the low formed right here, right there on that candle. So by looking at that range, okay, we have a range of 71 pips, okay, very close to the previous day's daily range. We have this range here, which is 104 pips rather. Okay, again, that's this day's high and this day's low. And what this indicator does is it actually plots the previous day's high and low, so you can see it graphically. And there's a lot of uses for that, but we're not going to go into it here, but you'll hear more about it as we get into the 8th installment in this series. Okay, we have 64 pips on this range here. Okay, and now what did we just see? Okay, we saw 70 is, the pip range hanging around that 70 to 80 pip marker. We moved into 100 pips. Then in here we shrunk down to 60. So we had 70, 70s, 100, then 60. Okay, so we had a contraction in the daily range right in here. That means there is a pretty sizable move that's expected just simply looking at volatility alone. Okay, this is why it's important to know when the daily ranges start to contract. You need to be prepared because something's about to take place that you could capitalize on. Okay, we're going into a new week here. The market makes a small range again. Okay, and that's this low here, this high. Okay, typically Mondays we don't like to trade, but you can see the high and low here on this day. It's this range here. So we have 45. So the daily pip ranges have really consolidated into a smaller, tighter daily range. So we're much, much smaller than we were on this previous week. Market comes down, finds some support. We have the previous day's high here, which is right here, this candle here, and the low here. So we're going to put it on this so it's easy to see. 113 pips is this range here. Okay, so the ranges are starting to expand. Okay, and previous day's range as well. Okay, we have 59. So we have another small contraction in the daily range. So we would expect another move of significance. Now it doesn't give you directional premise. Okay, before I go any further, I don't want to confuse you here. When the ranges start to contract, that does not imply directional premise. It just means a volatility pop, if you will, where the market's really going to make a swing one direction or the other, is highly probable. Okay, we're going to add some directional stuff in a moment, but we have this daily high here and daily low, which is seen on Sunday's candle in here, or range, which we don't like to do too much trading on Sunday. Here's Tuesdays of that week's daily range. You can see that is communicated here, and we start moving into more larger daily ranges. We're above 90 here. Okay, and prior to this range here, we had on that Monday of this particular week, we had a range of 53 pips. Okay, so we started to shrink up, and we exploded, and we had a very nice increase in the daily range. Okay, 161 pips. Okay, which was seen here. Okay, so what I'm trying to draw your attention to in this is not only do we look at price action on the charts, but we're also measuring and keeping an eye on volatility, because when the ranges start to get small, okay, or if they drop off over the last 5 days much lower than the average daily range, we're moving into an area where we're probably going to have a very sharp price move. And again, that does not give you a prognostication influence, and it doesn't give you any kind of directional premise, if you will. It just gives you a neon sign that everybody looks for, that something's about to happen. Well, that's one of the best things you can have, because it's a shrinking of volatility. Okay, you have like this quiet before the storm. Okay, and because we're looking at a 15-minute chart and looking at one shot, one kills per week, okay, one cherry-picked scenario for the whole entire week that we really try to hone in on for an opportunity with the highest probability of profitability and the lowest probability of risk. That's that's what a professional trader spends his career doing. That's his routine. He looks for those conditions. There's a lot of opportunities that he'll let go or she'll let go by with no regard whatsoever about who else is getting it. You, in your development towards a professional trader, you want to be having that mindset as well. You want to be moving towards a level of consistency and not feeling like a dog in a meat market, just running around chasing every little thing hanging off of a counter, nibbling here and nibbling there, and never really being satisfied. it- I can't express how satisfying it is to sit on your hands and wait for a specific environment, specific condition, specific setup, and then watch it unfold exactly how you have waited for it patiently and then take advantage of it. Execute, no fear, no worry, no rushing, absolute patience, and there's no emotion whatsoever. The emotion comes on the other side of the trade when you get out, hopefully with profitability, hopefully with having very little drawdown during the trade. So moving in that direction as a developing trader, that's where your mindset should be early on. And if you haven't done that and you've been trading for a while, you'd be surprised if you started doing that very thing, how much more significant your results would be. And it would clear a lot of the emotional and fear and greed aspects that come inherent with trading. So understanding the contraction of the daily ranges again is vital to understanding when the next big move, quote unquote, um, is about to ensue. Because we as traders, that's what we need. We need volatility to make money. Okay, if the markets don't move, it's very difficult for us to make money. Okay, unless you're an options trader, which I'm not going to be claiming to be an avid options trader, but there's certainly means of taking advantage of the marketplace when there is quiet markets. I'm just not that type of trader. I need action. So let's go back and look at a few things. Okay, the previous video we talked about stop loss placement and managing trailing stops and such, and I really want to hone this in down to a very core principle so you can understand what it is specifically that you're trying to do when you place your stop and why it's important to have a specific uh, number of pips as a like a template, if you will. Because we're trading with a one shot one kill mentality and looking for one choice setup for the week, we understand, we looked at a few daily ranges here. Okay, while it is not always 100 pips, I classify the average daily range for the euro and maybe the British pound, USD, in other words, cable and fiber pairs. I classify them as a generic 100 pip daily range. Now, please do not send emails to me, okay, or message me on Twitter saying, Michael, the fiber doesn't have an average daily range of 100 pips every day, or it hasn't had it for this number of days or whatever. I know that it will move in and out, okay, but in my mind, I adopt a 100 pip daily range. Will it always have exactly 100 pip? No. Will it go over it? Certainly. Will it double it sometimes? Certainly. Okay. Will it go very, very small and have even a 40 pip or less daily range? Yes, it can do that. Okay. So please don't try to start an argument with me because I'm really not interested. Okay. I'm I'm showing you how I view the market. It's up to you whether you discern if it's any value or not. Okay. Um, but because I have framed it with an average of 100 pips on a daily basis, okay, 1/3 of that, okay, is about 30 pips. Okay. And my premise to trading with a one shot, one kill mentality is if we're in an environment where we already expect bullish prices, okay, if we expect bullish prices, we've looked at the higher time frame daily chart, maybe the 9-day and 18-day are signifying that it is a buy model right now. Everything is institutional flows are moving higher. We've come off of a nice higher level support levels. okay, and breaking resistance levels. Everything is bullish, okay. We've already learned that the market finds its low for the week typically between Monday and Wednesday's London Open. Very high probability for Tuesday's London Open to create it, but again, we're flexible because we are not trading in black and white. We trade in the gray. Okay, so we have to thrive in the gray. We have a general rule to expect the higher low to form by Wednesday's London Open. Okay, but there's going to be small deviations in that periodically. Okay, it's because just simply because we want it to be like that always, it's not always going to be like that. So you have to have some flexibility in your trading, and that goes along with your analysis as well. So we're going to go back over a few concepts with this whole week in mind, okay? And again, we're looking at September 30th to October 4th. And for time uh, uh, reduction on the video, again, I'll just counsel you to go to your daily chart, pull up your moving averages to confirm this is indeed a time frame when the market is showing institutional flows being bullish with the averages crossing and everything trying to move higher. We have Wednesdays trading here, we have Tuesdays trading here, and Monday. We had a range, okay, from Tuesday's high here and Monday's low. Okay, so market made a high here early in the week, took out this high here, and traded back and receded back into Wednesday. Now this candle here, move my little things here so I can see what I'm looking at. This candle comes in at 12:15 GMT, or 12:30 GMT rather. Now that's classic New York open. So while we did have the market make a nice little low here, and during its London session here, New York came down, swept that low out, and then the real move came. Okay, so we talked about that stop rating event. Okay, but more specifically, we're going to go a little closer. Okay, you can see what we have here. This is that Monday and Tuesday. We're going to pull up the range, pulling the low, dropping our fib right on this high. Okay, so we've outlined our range here. Okay, and we also know that because the market has been moving lower, we're bullish. We're looking for buys. Okay, in this environment, based on the daily time frame, we will be looking for bullish scenarios. Okay. Okay, so we have our fib from the low here up to the high here. Okay, let's go at just one more little click here so you can see what we're looking at. Here's that Monday low, Tuesday's high, and markets finding lower prices, and then we move into, this is London Open for that Wednesday on the 2nd of October, and then the New York Open comes down, raids those lows. Okay, see how clean that is? They're just about the same level here, and that's a real high suspect area. Or a pocket of stops will be resting, okay, or a liquidity pocket, and then or liquidity pool rather. And market comes down, raids that area here, assumes all those pending orders. That would be what? They would be sell orders. Okay, they would be sell orders, because anyone that would be trying to buy long in here, they're protecting in their mind by having a stop loss in the form of a sell stop. Because if the prices come down lower, they want to be getting out the market. That sell stop becomes a market order to do what? Sell at the market. Who would be willing to take the other side of the trade? Those that are in the know. So when they took price down here, then you saw that rally up. Here's what we want to know. We want to know on the 2nd of October, when price was dropping down, was there something over here, okay, that it was trying to fulfill? Well, if we go out to an hourly chart, here is the bearish candle prior to the bullish move up. Okay, let's zoom in a little bit more. Okay. There you go, right there. So we have price coming down, touching that hourly order block prior to that big move here on the 30th. And then we move higher here on that Tuesday, and then we have that market receding down. Notice how price comes right down into that sweet spot as well, okay, but does not violate the 79% retracement level. Comes right down to the order block here, okay. Let's take this off. You can clearly see what I'm referring to. That's how precise it gets, okay. So when price comes down, hits that level, it starts to rally up. Now here's where we're going to introduce the concept of the effective stop loss placement. Okay, let's go back down to the 15-minute time frame, okay? And we're going to show this is the whole London session open, not the whole session itself, but the London Open as defined by me. And here is the New York session. As defined by me. Okay, and we're going to assume again that all things that we discuss in this video series were favoring an area to be buying in here. We're going to highlight this area here. Again, we're looking at this point here as the beginning of time and price. In this area here is where we'd be looking all the way up to the last portion of New York session. So what I did was at this outside edge of this rectangle right here, and the beginning of this rectangle edge is approximately at the beginning here. So what I've done was I've mapped out this whole area of where time and price are conducive for a buy. Okay, so now we're going to take the fib off, and 135.10s are a nice round number. We're going to assume that this level here is what we traded. I'm not going to use this as the ideal scenario, okay, because I'm going to show you how powerful this stuff is, and you don't need to be so precise. This whole area we've identified as a level of opportunity. Okay, so this is a killing ground inside of kill zones. These are kill zones. This is a killing ground. Okay, this is an area where we'd be stalking a setup. We don't look for any setups during this time period because this is a dead lull in the marketplace. This is like quiet time. You want to be trading in the New York Open, I'm sorry, the London Open rather, or the New York Open. But we're looking for this move for the weekly range to continue moving higher. So as the market moves from Tuesday's high down into Wednesday's London Open, okay, this is an area where we would be hunting a setup, okay? If we used this price level here is 135.07. Let's assume for a moment we traded at 135.15 right in here, okay? Nice little area. It's previous day's low in here, right in here. So we're going to use that as our entry point, okay? Because dealing ranges and bank traders like to use previous day's highs and lows. We're going to assume for a moment that we took that trade long in here, in this consolidation little area in here. We went long there. If we use, let's get rid of this rectangle here. If we use 30 pips as a stop, our stop would reside down here. Okay, 134.86 or thereabouts. Okay, and our entry would be approximately, let's go down to where we said 135.15. Okay, so we have our entry points. And that's showing 28 pips. I would need this to go a little bit deeper. There you are. And that's why, again, I like to use 30 pips, because let's look at this. Okay, with this range, okay, from that low on that daily range, look how much of that daily range it consumes in terms of total daily range. Here, look from this daily's high. Okay, it's Tuesday's high. Look how much of that daily range, okay, is consumed with that price mass, that magnitude of price. Again, the low forming right here on that candle right there, that's the daily low. Look how much of that daily range is being consumed with 30 pips. So if you combine, okay, if you're combining the mechanics of entering the marketplace at a specific time during a specific kill zone like London or New York Open, specifically looking for the setup here, even with this stop rate right there, okay, right there, you are not going to miss that opportunity to get long. You're not going to, okay? So when you see this move price stabbing down like this, okay, by having all these levels identified, you would at least be willing to see it trade down to that point here, and your stop loss isn't triggered. You're still a good chunk away in terms of pips. There's no reason for you to be fearful of that, okay? So again, 30 pips, okay, 30 pips if you are timing your trade with one shot, one kill, looking for the choice days to be looking for the low to be forming Monday, Tuesday, or Wednesday. Okay, even with imperfection with your entry point, this is why I use 30 pips. Okay, and for those of you who've already started thinking earlier on the video, oh look, he picked the most cherry picking scenario there is. No, I gave this scenario to show you how even when my tools did not give me the perfect entry, but still allow me to be involved in the marketplace. Okay, these lows in here, resting below that would be a nice area of stops. Okay, so there'd be a liquidity pool there. The market rallies up a little bit and then comes right back down, takes those participants out. Okay, this is the Judas swing in here. This is that false move lower. Everyone would be chasing that prior to the move higher. Okay, so we have the London Open, the New York Open. By having that that framework, okay, we could be long in here looking for a move going into Friday. Okay, here's Thursday's trading that week, and Friday does not make a higher high in here. But now let's go back to the stop loss and how we manage them. You're going to see why, again, I use this specific example because, again, it shows you how you get the lines portion of the move and you're not absolutely getting the low and you're not absolutely getting the high. Okay, so now let's assume for a moment you went long in here. Your stop loss, obviously, as we just detailed, is down here. Okay, so by having this entry point, the market moves up. Okay, we're looking at a 15-minute time frame. What you're going to look for are the swing lows on the 15-minute time frame. Okay, and you're going to be looking at the most recent two as the market starts to move up. Okay, we took out the previous day's high here, right there. Okay, so it's this swing low, and then when this swing low forms, okay, here's this one and this one. So now you can move your stop loss from 134.85 up to this low here, just a little bit below it. Okay, so now by having that set up like that, so now again, looking at how the market moves higher, this would be a nice level to take some profits. Okay, but now we're going to be looking to preserve our open position. Okay, so if we took a portion of the trade off in this area here based on the previous day's high, nice reason to take it out. Not all of the trade, but some of it. Okay, we have, when the market starts to move up and take out this high here, we have this low and this low, but now we have this swing low here. Okay, so now you have this low and this low. So now you can move your stop up to just below this low. Okay, so over here your stop loss would be right about in this vicinity right here. Okay, market comes down, does not rate it. Okay, as the market starts to make a lower low here than this one here, are you nervous? Probably you are. But are you stopped out? No. So what do you follow? The rules or your emotions? The rules. Okay, so now when the market starts to rally up here and takes out this high here, right on this candle here, you look at where we're at in terms of swing lows. We have this swing low and this swing low. Which is the lowest of the most two recent swing lows? It's this one here. So you would be able to move your stop loss just below that one. Okay, so now as the market rallies up, okay, and starts to drip lower in here, we have not made any new higher highs. Market eventually comes down and boom, takes you right out, right at your stop. Okay, and what happens as a result? Are you upset about it? No, you controlled your risk. Did you make money? In this example, hypothetically, you would have. Okay, so that's one example using the stop loss rules and applying the weekly ranges and such. Let's look at again, assuming we got in at 135.15 and you got stopped out on your whatever the balance would be. That's 66 pips. Do you remember at the beginning of this video series we talked about how 30 to 50 pips a week you can build a career on? There's 60 pips laid right at your feet. Did you trade every single day? No. Did you beat your head against the wall trying to figure out where the next bat pattern is, where the next crab pattern is, the next ICT reflection is? No. Okay, you would have a clear-cut routine that you would look for specifically every single week. You should know what you're going to be looking for. Okay, are you going to be looking to be a buyer or a seller or sitting on your hands? Okay, or are you preserving your capital because you're already in position? You're either managing, executing, or sitting on your hand. Simple. Okay. Now, with all that, uh, the topic of daily ranges will be much, much more involved in the 8th installment of this series because we're going to talk about the 5-day average daily range. We're just going to briefly mention it here, but I'm going to reserve a much more in-depth discussion until the 8th video because I'm actually going to have the tool released at the time I do the video upload as well. So, but those of you who don't have the 5-day average daily range indicator for MT4, you'll be able to get it for free. I'll share it with you. It's the one you see me using in my videos. But regardless of what type of trader you are, okay, and we're going to be talking about trade classifications now. Why is it important and what's the big deal? Okay, number one, if you are short-term trading, okay, for instance, everything was bullish going into this week here. Maybe you saw this as a selling opportunity on the lower time frame. Maybe this is an optimal trade entry that you sold into. Okay, and the market came down, and you were thinking, "Wow, I'm really smart. I'm making money." But all of a sudden, you married the vein. The higher time frame, intermediate term trade setup based on the daily time frame suggests that this thing's going higher. Technically, can it always unfold like that? No. Sometimes you're going to have where the technicals suggest that it may continue to go higher, but it doesn't do it. Okay, and that's when you get the climax reversals. We're not covering that in this series. It's important that you understand that that's not what I'm trying to teach you here. I'm trying to teach you to trade within that big lines portion of the moves. That's all you need. You don't need to be specific highs and lows. You don't need that. Okay, so that's the powerful concepts coming through and bleeding out all the high-end nervousness that is presented with traders that feel like they got to catch the highs and lows. You don't need that. Okay, notice that this trade setup was not the low of the week. The low of the week was formed on Monday. Okay, this was a nice move. I'm not going to argue with anybody that would be short this. Okay, say you shorted up in this area here around the 80, come down here around, it's 60 pips. There's nothing wrong with that. That's equivalent to what we would have made on this trade. So what? That's not your trade. That's not your trade. And that's how you look at it. Guys can come on the forums all day long. I took this trade and I took that. And who cares? You can't make any money on that trade. And you can't lose any money on it either. You can't gain any glory. And you can't swallow any pride over it either. So what difference does it make? While it's educational and inspiring to see other people's results, do not assume that that should have been a trade that you should have took. Why? Did you do the homework on that trade going into it? Because if you didn't do it, it's not your trade. Okay, so keep that in mind. You have no reason whatsoever to worry about what the next guy is doing. None. Okay, so that 5-day average daily range is going to be crucial to us in the 8th video, but for now we're just going to understand that we're going to have to learn to take something off regardless of what type of trader we're trading within, either intermediate term, uh, short term, day trade, or scalping. But if you are marrying the vein here and looking to be a seller on this Tuesday with an overall higher level intermediate term bullishness underway, you'll marry this vein here and if you don't manage your stops right, okay, you can get killed. Look at, I mean, it didn't take very long for this market to come back up to that high here. Okay, so all those folks that were shorting here and didn't use proper trade management, okay, and risk controls and preserving capital and taking profits as the market moved lower. If you were thinking, get in, I'm going to get out all my profit at my target, that's it. It's either all or nothing. Well, guess what? Boom, you got nothing. Okay, that's what this video is going to be dealing with. Why it's important for you to take something off, because you're never going to be 100%. As long as I've been doing this almost 20 years, I'm not always right. I'm not always right to where it's going to go to. Okay, so I work within a 75 to 80% range of what I think the move's going to do. I drop back down to about 80%, sometimes even 75% of what I expect to see it in terms of magnitude, moving higher or lower, and that's where I'm trying to get to. I'll let the rest of these guys try to beat their chest and say, look, man, I got all the move. Good. I applaud you. But over time, you will not be doing that. I guarantee you, you will not be doing that. So don't go into this game thinking that that's what you should be doing. Okay? So now, with the 5-day average daily range mentioned briefly that you should be always trying to take some profit off there. Okay, let's talk about multiple time frame trading. Okay, multiple time frame trading. Again, we discussed obviously the daily chart is used for intermediate term trading, okay, or swing trading. Then you have the short-term trading, which is classified and the analysis is done with a 4-hour chart. Then you have the day trades that are arrived by analysis on a 1-hour chart. And then anything at 15 minutes or 5 minute is obviously scalping. Okay, so when I say scalping, I'm not talking 3 pips and 5 pips and 6 pips. That's not that to me. That's goober trading. Okay, if you can't at least make 15 to 20 pips on the setup, don't even do it. Okay, now how am I saying if you can't make it? There's no guarantee that anything's going to unfold. It's just like reward or risk. There's no guarantee that those things are panning out. But if you don't at least plan to hold the trade to make at least 15 to 20 pips, if it moves favorable for you, then it should not be taken as a trade. That's just the way I look at it. You may argue with you and say, I can make 10 pips 20 times a day. Great. Then you're a good trader, and I'll leave it there. But you're watching this video wanting to know what I do, not necessarily having to have to do it, but I look at the market where if I can't make at least 15 and 20 pips, or at least willing to hold it in that magnitude of pips, I'm not taking the trade. Okay, and that's usually where I'm trying to either take something off the trade or aggressively move the stop up to even, or taking some of the risk off at least. So now, because we classify the trade in terms of intermediate term, short term, day trades, and scalping, we have to also understand that there is a classification for trading in sync and out of sync. Okay, and what do I mean by that? Well, the two higher time frames, which is the daily and 4-hour, If you're trading in those time frame directional premise, then you are classified as trading in sync, regardless of what time frame you're trading. Now, you can trade counter trend or counter sync, if you were out of sync rather, um, as a day trader and a scalper. Okay, or you can actually short-term trade, counter the higher time frame. Okay, but you got to be very, very nimble doing that. So I'm not going to advocate doing that in this video series, but you see me a lot of times in my market reviews or my trade recaps that I do on YouTube. It may go against what the higher time frames are saying, but I'm still netting pips. That comes with experience. Okay, I do it just to show you that you can make money without a directional premise or bias, but it's just better for your trades if you're trading in sync with that daily and or 4-hour time frames. Okay, so if you're day trading in sync, that means you're going to be, if the higher time frame daily or 4-hour are bullish, then your day trades, if you're a buyer, then you're trading in sync. Okay, just remember that. If you're selling in a day trade or scalping short, while the daily and or 4-hour are bullish, okay, you are out of sync, okay, or you're counter trend trading. That's a very, very important rule to understand in terms of your analysis, because if you can't generically define your market environments like that, or you're trading within the current environment, in my opinion, you're trading in the dark. Okay, you will not be rule based. You'll be seeing moves like this in here. It's really dropping off really handsomely, and you're gonna think, wow, it's gonna probably come down here deeper. Well, it may not. As you can see here, it doesn't, and then it starts to rally the other way, and that's very demoralizing if you haven't taken some profits off as the way the market moved lower, and if you didn't even adjust your stop. The guys that want to sell up here, and I'm going to keep my stop here and take all or nothing. Well, you got nothing again for the time and effort you put into the market. It's important that you have something out. Take something off the trade, okay? It doesn't make a difference if it was 20 bucks. You got 20 bucks. It's 20 more dollars than you had before you put the trade on, okay? I used to be, I'm going to get my exit or I'm going to get stopped out, and that's just the way it is. And man, I got chewed up. You just can't do that as a developing trader, because number one, your mind's not going to let you do it. Okay, you're going to start saying, well, I took this many losses, so I'm going to be over trading. I'm going to take more trades now, and I'm going to widen my stop because I know I'm right, or I'm going to be buying more and over leveraging. Okay, and I'm going to get out sooner than I should because I just need to get that money back, and it just causes all kinds of havoc, emotionally and psychologically, and then you forget about what you're supposed to be doing because you're focusing too much on the pain. Okay, so by having these rules in place, it helps you define what it is specifically you should be doing. And that alone is what your focus should be. Because think about it. If your perspective is limited to just those things, do you have time to be worrying about where it's going to go to? You already have a stop loss defined. You're either going to watch your six and collapse 50% of the trade, or you're going to let it go down and hit your stop. Period. That's it. What's to worry about? If you're worrying, it's because you probably put too much on the trade, or you've probably been trading too much. It's just that simple, guys. But we want to overanalyze it and blame something else outside of us. Okay, I get a million emails asking what it is that makes me do the wrong things. Well, inherently, that's human nature. And we said this earlier. If you see a sign on the lawn says don't walk on the grass, what do you invariably want to do? As a kid, if you have children, my kids want to do it all the time. Don't touch wet paint. Man, they got paint all over their hands. Osh gosh bagosh, it's got paint all over it. Okay, their new Nikes, boom. It's got that new stain that was on the picnic table that we were going through the park, and it says don't touch this. It's got wet paint on it. Got a little rope around it. Okay, well, they're going to go through the rope, cross the red tape, if you will, the hazard warning, and they're going to do the very thing that you're not supposed to do. Okay, that's human nature. So that gets back to, are you going to be a rule-based individual? Because if you can't follow rules, you're not going to do well with this business. You have to be you have to be disciplined and have it defined very, very clearly what it is specifically that you should be doing. If your trade plan is very detailed, one can argue I have too many moving parts in my plan. Okay, I don't have a whole lot of moving parts in my trading plan. I have a whole lot of moving parts in my understanding of how the markets themselves work. That's why I'm so effective. That's why my analysis before it happens is so accurate. That's the premise to why I'm doing these things, because I want to communicate that to you. You can do these things, but it's going to take time for you to overcome the you. Okay, so by having a classification of your trades and understand what you're trading and why you're trading it will help you define where you're going to take profits at. Okay, so avoid that I'm getting all of my maximum profit. Don't do that. Okay, because first of all, you're not going to be right more times than you think you are, and you just want to pay yourself something. Okay, and having that mindset that I'm going to have the maximum profit always, because think about it, when you first started, you got in there, you looked at the charts, pulled out your calculator and said, man, I'm going to make 20 pips a day. I could do this, 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 and all of a sudden in 9 months you're a millionaire. 1 500-hour trading account. It doesn't work like that, guys. It does not work like that. You have to overcome a whole lot of internal things before these charts ever do anything for you. So the way you grind that out is begin with a rule-based system, okay? And the more rules you have that are clearly defined, the less room there is for emotional, fear-based, and greed-based trading. It's just that simple, okay? So now let's move on and take a look at the ICT split gain ratios. Okay, guys, we're going to be looking at the intermediate term ratios. Now, what is a split gain ratio? Well, it's it's something I just really classified just for teaching purposes because I don't have any real specific. I do this every single time. I don't have that. Okay, so I'm giving you these ideas to stimulate your decision making in your own trading. Okay, so don't think for a minute that this is always going to unfold exactly like this. It just obviously means for you to stimulate your decision making, and you can come up with your own way of using these as examples, okay, to arrive at what you're most comfortable doing, okay? And the only way you're going to learn which one you're comfortable doing is by just simply jumping in the pool and joining it, okay? So an area term ratio, okay, would be how am I going to take my profits, okay? Assuming that you have $100,000 leverage in a trade. In other words, you have what we considered a standard lot. In the euro, that would be $100,000. But each pip is going to be worth $10 per movement up or down, gain or loss out of your account. In this example, okay, for intermediate term ratios, if you are in sync, trading in the higher time frame daily and or 4-hour directional premise, okay, you can take your profits in stages of 20, 20, 20, 20, 20. Okay, in other words, out of 100% of that total position, okay, you could take 2,000 of leverage off at your first target. At your second target, take another 2,000 of leverage off, take another 2,000 off the third target, fourth, and final fifth. Okay, that's the like an ideal scenario if you want to scale off in 5 position exit points. Five's a whole lot, um, but again, we're talking about intermediate term trading, so you could take that first 20 off at the average daily range for that particular day you took the trade on. Okay, and then the next 20 could come off at a previous daily high or a intra-week high, and then the next one could be a monthly high, or we could start looking at Fibonacci 127 and 162 extensions. Okay, any one of those things could be applied here. Okay, but it's a matter of how much am I taking off. If you're going to take out 4 scaling, you could do 25, 25, 25, and 25. But where you're taking those profits at, okay, you're taking $2,500 of the 100,000 that you put the trade on at logical levels of profit taking, old highs, old lows, Fibonacci extensions, okay, previous range retracements. In other words, like a move, say this high here down to this low, as price moved up into what would be considered the 79% retracement level here. If you were long back in here, you would be looking to take some profits in here. Okay, and then obviously if it gets to this level here, we could take profits there as well. When price starts to retrace, okay, assuming that we were able to be a part of the next leg up, if you were buying in here, okay, this old high would be an example, this old high would be an example, and then the extensions beyond that, okay, like this. If we have our fib, pull it down to that low, our 127 would be an ideal level to take profits at. The 162 would be a nice level, and ultimately our higher level profit objective is the 200 extension. We're here, okay? So it's using all the concepts together in a framework where it allows you to just really plan your exits and look for reasons to do it, not simply because I made this much money. Where are we reaching for in terms of price action? Okay, and applying all of our tools. If you want to scale out in 3 stages, you could do 20% of the position and then 40 and 40. Holding on to those last two portions at 40 and 40 because you want to be, hopefully, holding a larger percentage of the trade because you're trading in the higher time frame directional premise, okay, or what we considered in sync, okay. If you're trading out of sync and you're against the daily and or 4-hour, and you want to scale out in 5 stages, you can take 40% off initially at a price objective, and then 10, 10, 10, and 10. Okay, leaving small portions on. Okay, and even if just sake of luck, even though you're against the higher time frames, you could still manage to get some pretty good gains, like we have here, and like we have here. Okay, so it was against the higher time frames, but you're still able to hold a little bit of piece of the position on, and maybe catch some more of volatility in your trade. If you want to scale out at 4 stages, you could do 50% of the position, then 30. So you got 80% of the trade off, and then you can hold on for the final 20%, scale those off at 10 and 10. Then you have 3 scale stage. If you want to take 60% off, that would leave 40%. You can scale off in 2 more stages at 20%. Again, using logical levels of price levels and Fibonacci, simply applying that overlapping of reasons or confluences for price to be moving to those levels. That's where you would be doing these split gain ratios. In other words, where I'm going to be taking my position off and how much of the position that I initially put on would I be taking off. Now this gets back to your trade entry. Okay, you can do this several different ways. Okay, you can set your position up and do it as individual orders. Okay, in other words, if you're trading 100,000, you can assuming that you're trading in sync and you want to scale out at three levels, you could have your entry limit order, 3 separate entry limit orders to get the same price. Then your first of the 3, you could look to take profit off at a first objective. Okay, but the positions would be set up in such a way that you would have 2,000 leverage, 4,000 leverage, and then 4,000 leverage. Okay, so you're going to take the first 2,000 off at your first price objective. Remaining 2 positions would be open, and then the second one would come off at another logical level of price objective, and then once it's triggered, the remaining order of $4,000 would be setting in the marketplace, and either it gets to its position or stopped out or whatever. Or you could just do the trade as $100,000 and then go in and set your limit order to take partials off. Okay, and some platforms will allow you to do that. I don't know what every platform each of you are using. You just got to look and see what is available to you. Okay, let's move on to the next one. Okay, short-term ratios. Again, assuming that we're trading in sync with the daily, the in sync ratios would be taking 30% off if you're scaling out at 3. In this case, it looks a little differently because I'm taking the smaller one first because I want to have the maximum amount of leverage still in the marketplace in my position. So I'm going to take 30% off, and then I'm going to take 35% off the second profit objective, and then the remaining 35% would be taken at the third and ultimate price objective that I would have for that short-term trade. 25% if I want to scale out in 2 stages, 25% at the first one, and then 75% at the second price objective. And to give you an illustration of what that might look like is if I'm trading with a 4-hour chart, okay, and all I did was just geared down. I didn't do anything. I didn't pick anything. It just gave me this chart here. Assume for a moment that I went short here on this optimal trade entry, right in here, and back into this order block, right in here. So if I went short in here around that 131.80 level, the first price objective would be down here, this old low, which is the reaction low. From this point here down to here, that would be my first price objective. Again, scaling out a short-term trade at that point here, it'd be 146 position. I'm sorry, 146 pips for the first scaling out. Okay, so if I'm scaling out in 2 stages, 25% would come off the trade right there at 140 some pips. The next point of the ratio would be 75%. I would take that out at either the 127 extension or the 162 extension. Conservatively, we're just going to say the 127. We're not going to say we got everything down to here. If you got to the 127, the remaining portion that would be in the trade would profit, hypothetically, obviously, to that price point here of 191 pips. Okay, and just for sake of completeness, if you use the 162 extension as your final position, you'd make 248, and if you held for the 200 extension, you'd make 310 pips. Okay, and you would just do the math on what you would make or risk on that trade. Now, if you're trading out of sync, okay, for short-term trading, you want to take larger portions off sooner. So you would take 60% of the trade off, and then 2 remaining positions at 20 and 20. Okay, and again, all you're doing is looking for levels to take your profits out at that ratio in terms of your open position. Initially, you're scaling off a percentage. In other words, in this case, out of sync, you would take 60% off initially at your first target, and then 20% off at your second target, and then 20% remaining would come off at your third and ultimate price level. Okay, and in a good example, that would be 60% off at an old high or low that you used your fib from, and then 127 would be coming off at 20%, and then 162 extension or 200% would come off on that final 20% of the initial position. And if you want to do 2 stages on scaling that you're out of sync with on the higher time frames, you would take 80% off initially, and then let your 20% remaining on the position go to your second and final objective. And obviously you can do double tap, which is 50-50. In other words, you take your first objective is half the position comes off, move to break even, and then you hold for your second objective, and you don't care what happens at that point. Okay, and moving on to our day trading ratios. Okay, looking at this, if you're trading in sync, you take 30% off of your position on the first target, and on the second target, you take 60% off, and then you would leave 10% to see what happens. Okay, because again, just because you're day trading doesn't mean you can't try to capitalize on a move that would most likely continue on for several days. Day trading, don't think I got to get out all of my position today. Take a good chunk of the market out and move to no risk and lock in profits, but leave a little piece on there because you may catch a lot more of the daily range increase going into Friday, or it may even continue going on for weeks. If it works its way where such your stop is never tagged, you'd still be in the market as it continues to move in your favor. Obviously, if you want to move out in 3 stages and you have all 3 time frames in sync, Okay, you could take 20% off, 20% off at your first two targets, and then leave 60% remaining for your ultimate price objective. That's again only if you're trading with all time frames in sync and everything's just loaded for it to move up. And then if you want to do it in two stages, you would just take 20% off at your first target and then leave 80% for your uh, ultimate price objective. In other words, if you were using a day trading entry to get in sync with a position or intermittent term trade based on the daily time frame. So in other words, that's the reason why you would be holding 80%, just taking 20% off and holding 80 for as much as weeks. And if you're trading out of sync, you would take, obviously in three stages, you would take 80% of the position off at your first target. Two remaining positions you can take off at 10% and 10%, giving you your full 100% off. And in two scaling stages, you could do against the higher time frame, you would take 75% of the position trade off. Remaining 25% you would take at your second price objective. And obviously, if you want to still simply just do double tap when you're unclear. Okay, in other words, if you just don't know if you're in sync or not, and you're day trading, it's easy. You just do double tap. Okay, take half the position off at your first objective, go to break even, and then look for your second objective, 127 or 162 extension. Period. Short and sweet, nothing fancy. Okay, moving on to our last ratio. This is scalping ratios. Again, this is for 15 to 30 pips range, that type of trading. You either hold for your stop to be hit or your target, okay? And either take a loss or that you risked initially on the trade, or you go to break even. In other words, if you're able to trim some of that risk away. That's pretty much, and that's what you're trying to do in an ideal world. If everything's in sync, that's how you trade it. You look for your stop loss at maximum loss or target, or if it allows you to trim some of your risk away, you move your stop loss closer to break even, eventually into profit. But that's scalping for you. I'm not going to try to give you too many things for scalp because I really don't think traders should be doing that. But I know there's a people group out there that wants to hear about it. So there you go. Or you can simply just use double tap. As soon as you get to 15 to 30 pips, you take 50% of the position off, and then you can leave the position open and catch anything that would be in sync with the higher time frames. If you're counter trend or out of sync from the 4-hour and daily, always watch your 6. You would look to take 50% of the trade off if the trade is questionable, and just manage it like you would if you were trading in sync. Okay, so it's really a generic way of looking at how I scale out profits and how I manage the position. Um, I generally have what ratio in mind before I even put the trade on. Okay. The only time that it will deviate is when I'm in a intermediate term trade. I may elect to take more or less of the position off at the second, third, fourth, and fifth stages. It may become a third stage, a three-stage trade where I take all of my profits if it moves in my favor versus a 5-stage scaling out. In other words, if I think it was going to move to the 200% extension and I'm in that move favorably and I've taken off my first two scaling stages, that third, fourth, and fifth actually may just drop down to, I'm just going to take it all at the fourth, or I'm going to drop it down to what would be considered the open remaining position of the trade. Say it's 30% of the trade. I may take 15% off at one level and then 15% off another level. So again, don't think that you're locked into these ratios. This is a means of you deciding what you want to do at the price levels that we've talked about in this course. That being old highs and old lows that you use your reference points for your fibs, your 127 extension, 162 extension, and then your 200 extension. That's it. There's nothing more to it. There's nothing difficult about it. It's just a matter of planning your trade around that analysis and where those levels are, how much you're going to do of profit taking when it gets there. And preferably you want to have those in form of limit orders. You can always manage the limit orders after they're already in place. Treat them like stop loss orders, okay? Because many times you'll be surprised how fast some markets will move, and it'll get to your first price objective. And if you didn't get that and it recedes back to your stop loss, again, very demoralizing. Okay, so I counsel you to try to use these as templates, if you will, to frame your trading and your level of scaling out profits. That's really all there is to it. It's no magic behind it. Um, what you see here for 20 and 80 could very easily be 70 and 30. There's no iron uh, set of rules where you have to do it this way and only. Okay, it's a unique thing for us as traders. We can tailor this stuff to our own um, personality. So again, it's just a means of stimulating decision making on your part to scale out something and really to stimulate and try to inject the idea that you should be taking something as profits as the trade unfolds, because just simply because you think it's going to go up to a specific price level, there's no guarantee it's doing that. And it may not get there without coming back down to another previous level, and it may be the level your stops at. Okay, so pay yourself, get something out of the trade. You've invested time and effort and probably fear and worry about missing the move in the trade setup. So once you're in there and you get some profits, get some of it out. Okay, so that's pretty much it for this teaching session in this video. I just want to give you some ideas about what we're going to be doing in the 8th episode and how to get prepared for it. I would counsel you obviously go back through all the previous videos, okay, and that includes this one. Go through your notes, make sure you have a good collection of notes, okay, and read those notes. You don't have to see the videos over and again once you go through it one more time, but your notes, you should read them at least once a day. Whether you're trading or not, read them once a day, because by doing that, it'll constantly feed your mind and you remember these things, and you see certain things unfolding in your chart. Say, oh yeah, that's that thing he was talking about, or that's that event that usually takes place. And then you'll start to learn how to engage the marketplace, and price action will become a thing of expectancy. Okay, you'll expect these things, not what's going to happen. Okay, when I sit down the chart, I'm not asking what's going to happen. I'm expecting something to happen, and there's a difference. Okay, if that went over your head, rewind it again, listen to that. It's a very different perspective. As a professional trader, I anticipate something, whereas novice traders are expecting something. What's going to happen? They're asking everybody on the farms, what do you think the euro is going to do? What difference is what I make? Okay, because really, are you going to trade on what I'm telling you? You shouldn't. So have that in your mind as you go through your videos. Again, get some good notes, and we're going to be moving into a really, really cool final episode. And a lot of guys that have been on the fence about my concepts I think, will be pleasantly surprised on how useful that video will be. Until then, guys, I wish you good luck and good trading. I hope you enjoyed this installment. And coming up in the last and 8th in our series, Escape and Evasion. Now this is pretty much like my be-all end-all for application for my tools. I get a lot of flack from the guys that aren't into me or into the tools, or just want to be adversarial. They'll say that I have too many components, and while I have a very vast understanding of market analysis concepts and techniques, I'm not always using every single tool. So it's just like a carpenter. They may have a toolbox full of all kinds of tools, but you're not really driving a screw in with a ruler. So there's certain times that you need a specific tool, or where a tool is multifunctional. Okay, but I did my very, very best to try to condense rather, and make it more concise as to when I reach for a specific tool or application or technique or concept, and when I avoid not using it at all. And I set it up in such a way, it's like a flow chart. And I think what you'll be surprised is that I've applied how I sit down and I look at the charts from a top-down analysis down to the smaller time frames, and what goes through my mind as I do the analysis. Okay, and it's kind of like an if-then format. So if the market is presenting me this specific criteria, then I will do this, this, or that. And if those functions are met with even more market conditions, then I move to another stage in my analysis. So it allows you to remove all the ambiguity, all of the fog, if you will. It's not. I have a lot of military themed uh, either concepts or titles or teaching templates, and that's just my personality. I've never been in the military, but I think by having this framework, it'll allow you to have like a plan of attack, okay, and it will give you a means of systematically attacking the market, and then doing your own you know research and recon, if you will, and then moving out into the fields and doing that your very own without having any kind of input or stimulus on my part or anyone else's, because that's really what we're getting at. We're trying to be building a measure of consistency, obviously, um, a means of limiting risk as best we can. We can't remove it 100%, but we're going to do our very best in our trading to try to do that very thing. And at the end of the day, we should be hopefully moving towards profitability. It's never guaranteed. I can't guarantee it. No other mentor, teacher, or author of courses can do that. So um, while it is my goal to try to give you a roadmap, if you will, on how I break down and digest the marketplace, it will still, and I'm promising you, it will still incur losses. If you trade with real money with these concepts, any of these concepts, not just simply what's released on the eighth and final video, but any of these concepts, you are still inherently taking on risk that will invariably result in you losing money. Okay, so you have to be very responsible and trade within a demo account only when you think that you're ready to do it with live money. You take that decision and you make it your own, and own the responsibility that comes along with it. If you have success with these concepts, obviously I'm more than excited to hear what each of you are doing as you're developing, and that's my motivation in doing all these things. I don't take any monetary gain out of it. I don't request any kind of subscription fees or anything like that. I get a high off of everyone else's development, and when I see the feedback through either Twitter or emails or on forums that they've developed to a measure of consistently profitable or encouraging results that lead to more you know comfort levels in terms of not being fearful of taking a trade. You'd be surprised how many folks are still fearful, just getting involved in a demo account because they don't want to face that right or wrong conclusion to their decision. And I'll have more to say about that in the last installment. But what specifically will be covered in the escape and evasion? Well, we're going to be overviewing the entire ICT Scout Sniper Basic Field Guide series in its completeness. Okay, because we have to do this in a more comprehensive fashion, it just means we got to go through it all over again. But obviously, it's not going to go 12 hours long, but we're going to break it down and be more precise and concise with what specifically you're supposed to be doing with each one of these videos and the tools that are within them. And we're going to be talking about adopting the ICT mindset to trading. Okay, we're going to be looking at the inner circle trader tips for continued trader development. A lot of things that I have not spoke in this series. I've held on to the last video, so that way it's at least 6 hours long. I'm just kidding. It's going to be long, but it's probably not going to be 6 hours. And we're going to be revealing the ICT flowchart to market analysis and tool applications, so that way you don't have to guess or wonder, would I be using this tool at this time, or would I be using that method at this time? No, you're going to have a very clear generic way of going through the market, breaking it down in a routine fashion. That way, once you do it for a period of time, you won't need the flow chart. You'll just know simply, okay, well, it does this, so therefore I'm going to do that. If it's done this, then I'm going to do that. So you're always going to have a response to the current environment. Okay, so either you're going to take action, you're going to sit on your hands, or you're going to protect and preserve your capital. Okay, there's your three um, engagements to the marketplace. That's it. That's all you can do. Either you're going to take action, you're going to sit on your hands and do nothing, or you're going to protect and preserve your equity. Okay, there's only three things that can happen in the marketplace as you as a trader, and you'll have every possible scenario that I could fathom, okay, in a manner of looking at the marketplace, digesting it, and saying, okay, what should I be doing? In the mindset that ICT or myself utilizes in trading. And obviously, like all good things, they have to come to an end. I'll have a few more words on accountability and consistency. So until then, guys, I wish you good luck and good trading.